So the best place to start is just to think about why 2018 was such a bad year for the crypto market. In some ways, 2018 was as bad a year as 2017 was a good year. So I've kind of marked that on this chart here. You can see we had an awesome 2017. Bitcoin went to an all-time high. And 2018 was really a painful year, where Bitcoin held 6,000 for most of the year. And then as we got into the final months of the year, we had the fork wars that essentially led to a systematic breakdown in confidence about the crypto market, and we had a collapse. Okay, so what made 2018 so bad? I think ultimately we could just say that expectations were too high. Crypto had a parabolic rise in 2017. You can't continue to rise parabolically, and so we had a pretty big adjustment. I think a lot of problems were also exposed last year. I think mainly there was a lot of capital raised in ICOs, and I think we saw really some of the worst of the crypto market in those ICO projects. And we had regulatory problems. The SEC in particular really kind of threw some cold water on the space, but more importantly, some of the banks instituted restrictions. It was more difficult to actually put money into the crypto economy. So let's say that takes us to the start of 2019. I think it'd be pretty normal if someone looks at a market that fell 80% and would be bearish. I think that's just normal human nature, right? Look, if something's down a lot, you either feel really bad owning this asset, or you think other people must be right, because there has to be a reason why the market would be down so much. I just want to tell you that there's a few reasons why 2019 should be quite a good year for the crypto market. Okay, so I think one, there's history on your side, so I want to talk about some of the history arguments. But I think that there's three very important developments happening this year that weren't in place last year. And I'm going to cover those, but mainly it has to do with the macro markets turning more positive. There's a technical improvement taking place in crypto, and there's some fundamental catalysts. So let's start with history. First of all, this is the price history of Bitcoin since 2010. This is the fourth major decline. In fact, it's the longest bear market in history. But as you can see, Bitcoin has recovered every time. So the question you have to ask yourselves, is the cryptocurrency and blockchain industry so mature that Bitcoin won't recover? I mean, just ask yourselves that. I mean, we're in the earliest stages of adoption. I don't think anything's changed. But you might want to take a look closely at that red line on the chart. See that bottom, that big red line? That's the 200-week moving average. Bitcoin's touching that 200-week moving average. That marked the low in 2015. So we're at a really critical point. This is a time when the technicals, or what you'd say price momentum, is beginning to improve. And if there's fundamental factors that are supporting that improvement, this is actually a great time to be owning cryptocurrencies and Bitcoin. So this is not a time to be dejected. This is a time to take advantage of that price decline and sort of counter to your own emotion of being either skeptical or nervous and realize this is quite a good opportunity. So why do I think 2019 will be a good year for the crypto market? Well, remember, there's two things that drive creation of value in any asset. So cryptocurrencies is no different. The first is really network adoption, right? Network value. Is this going to be adopted? Are there going to be people using this thing? And of course, we're in the earliest stages. I think that the outlook is still positive. But the second is whether the usefulness of this asset is going to grow. And I think the way we measure usefulness in our work at Fundstrat is thinking about whether enhancing the compatibility or connecting the cryptocurrency market to traditional financial infrastructure. The more that happens, the more likely that digital currencies become the new sort of financial architecture. So yes, in our view, there's a lot of things happening that are going to be positive in 2019. Now, it really comes down to three things. The first is that the macro is going to improve. And what I mean by macro is, macro refers to the idea that something is going to improve the attractiveness of blockchain and digital currencies as an asset class. Now, you may wonder, how important is macro to the performance of any asset class? In our work at Fundstrat, and I've been doing research for 25 years, we tell our clients that the macro decisions account for almost 70 to 80% of the return of any investment. Think about it this way. Making money in the stock market, 70% of the return that you get from buying Facebook is explained by a macro factor, whether it's economic, it's equity performance in general, or it's the growth of the internet. These are not company specific. And the same thing is true for the crypto market. The second thing happening this year, and I'll again have some slides, is the technicals are improving. And finally, there's fundamental developments like JP Morgan Coin. So let's go through some of these macros. So the first is this chart. This chart is, the red line is emerging market equities, and the dark blue line is Bitcoin. And this chart starts in end of 2015. Now here's something interesting. Notice that whenever the red line goes up, that's the emerging market stocks, that Bitcoin tends to rise. Well, last year, 2018, I marked it in the brackets, emerging market equities were falling. And as you can see, Bitcoin fell with emerging market equities. That's simply saying that equities, whatever is happening in the stock market is going to have an effect on the crypto market. As institutions actually begin to increase their investment in crypto, it's probably going to grow in importance. Ultimately, if there's a bear market in global equities, it's going to exert some influence on the crypto market. Well, what's happening in 2019? We know that global equity markets are rallying pretty strongly. I think that this global equity rally is actually going to pull in the crypto market. Now, the other macro factor that was a headwind last year, that's turning into a tailwind this year, is the dollar. So the light blue line is the dollar index. I've inverted the scale. So when the light blue line is rising, the dollar is weakening against other currencies. And last year, the dollar strengthened, actually rallied 13%, and as you can see, that was a headwind for Bitcoin. Now this makes sense. This is saying that if Bitcoin is a digital currency, it's going to be priced against the dollar. If the dollar's strong, Bitcoin could drop in price. Well, it looks like the dollar is set to weaken this year. We don't really know. It's very difficult to predict the long-term price performance of currencies, but if the dollar weakens this year, that's a tailwind for Bitcoin. Now, I've mentioned technicals, and I think the most important technical to watch is Bitcoin's price relative to its 200-day moving average. Now, Bitcoin, you might wonder, does it make any difference? Does Bitcoin behave differently when it's above or below its 200-day? Well, the 200-day moving average for Bitcoin right now is around 5,000. So Bitcoin still needs to rise about $1,000 before it's above its 200-day. But take a look at this chart. Since 2010, whenever Bitcoin is above its 200-day, its average 6-month gain is 190%. It basically triples every 6 months. When it's below its 200-day, its 6-month gains are 1/10 when it's above it. So in other words, Bitcoin very much trades within technical, or follows technical signals pretty closely. And that makes sense. Cryptocurrencies don't report earnings. They don't have, an investor relations department, so technicals play an outsized role. But what this chart's saying is the public, or most investors, are going to turn bullish once Bitcoin gets back above its 200-day moving average. So just keep that in mind. The 200-day moving average is 5,000, and Bitcoin's at 3,900. This chart here shows you at different prices of Bitcoin, if it holds these prices, when will Bitcoin cross above its 200-day moving average? And according to this, if Bitcoin stays at around 4,000, it's going to cross its 200-day sometime in June. That's the middle of the chart here. So keep that in mind. For anybody who does technical analysis, the 200 days is a big deal. That could happen within the next 4 months. Again, another reason to turn positive on 2019's outlook for crypto. And finally, I think there's a lot of positive catalysts on the infrastructure side. I mean, First of all, I think this was a very pleasant surprise. You know, JP Morgan launches their own cryptocurrency. Granted, it's permissioned, you know, but it is essentially digital money. So remember, this is a big deal. JP Morgan has gone from saying, you know, blockchain makes no sense to actually launching a cryptocurrency. We have pensions investing in crypto. Again, that happened just recently, but again, we had the first pension funds actually allocating money into the crypto market. You have to keep in mind, pension funds and endowments really help drive the growth of any asset class. They're the engines behind why private equity has blossomed, or why venture capital has bloomed, and also why hedge funds actually grew. So these, you know, the decisions made by pension funds and endowments are critical to the growth of an asset class. And finally, you know, BACT is going to launch later this year, and I think BACT is going to be quite useful. You know, it's really going to improve the plumbing between traditional financial architecture and the crypto market. So in short, I don't think you should be bearish about 2019. And just as a reminder, this is a chart we published in 2017. Bitcoin makes all of its gains in 10 days in any single year, okay? So even though there's 365 days to own Bitcoin, the performance comes in a very short period of time. The dark blue bars here show you the average return of Bitcoin if you didn't own it for the 10 best days in any single year. On average, you'd lose 23% per year. So in other words, all of the Bitcoin return occurs in those 10 days. So unless you're great at timing, I don't think you should be trying to time this market. Okay, so let's jump to digital assets are useful. I just want to see how much time I have. Okay. Okay, so first of all, I think these are some quotes, and I'm just putting them up here to remind you that anybody who is involved in technology or new technologies, even those who invent it, really never know the future. Now, I grew up as an equity research analyst covering the wireless industry. I started covering that industry in 1993 when there were only 34 million cellular phones in the world. Today, there's 4.5 billion. So I followed a market that grew by 1,500x. But I put some quotes here from technology pioneers. So in 1977, Ken Olsen, who founded Digital Equipment Corp., said there's no reason for any individual to have a computer in his home. And I think that might have been true in 77, but of course that's not true today. In 1981, Marty Cooper, who invented cell phones, and that's very close to my heart because I spent over 17 years following that industry, he said cellular phones will absolutely not replace local wire systems. Again, he made that prediction in 1981. He obviously had no idea how important cell phones would become. And then, of course, in 1992, Andy Grove said that the personal communicator in every pocket is a pipe dream driven by greed. So the point is, you don't want to be one of these people. And again, one of the keys here is that these folks didn't understand how demographics really affect the adoption of a new technology or in this case, cryptocurrency. So where do we stand today? I mean, Bitcoin's very useful. I mean, first of all, let's just think about blockchain volume, or the volume on the blockchain. Bitcoin did about 1.3 trillion of transactions. That's 2.5 times the size of PayPal, and it's 7 times the size of Discover. I mean, it's in a few years, Bitcoin's going to be processing more transaction volume than Visa. So clearly it's useful. And I've mentioned this before, but cryptocurrency exchanges, which is really where a lot of the activity takes place, so this is not on-chain, but really trading, you can see, BitMEX, which we estimate earned about $1 billion last year, would rank as the 3rd most profitable exchange in the world of any market. And we think there's many use cases for crypto. Again, I don't have time to cover this all here in my presentation, but I think the key here is people who are skeptical of cryptocurrencies are skeptical because they think the traditional financial system works well. Well, it turns out the traditional financial system works well if you're rich. But more importantly, the traditional financial system actually is quite expensive to operate. And so this is where crypto is useful. Crypto replaces the trust component on traditional financial systems. That trust is allowing banks to earn trillions of dollars a year. So that's the value capture. And second, crypto would optimize how the financial system works. So we call that optimizing working capital. Today, 14% of all global GDP is essentially tied up on balance sheets in order to keep the financial system liquid. That's a huge amount of waste. And of course, we think crypto actually works quite well as a store of value. But let's just think about crypto as replacing the cost or saving money in the traditional financial system. So most people think the banking industry is actually relatively cheap. If you're rich, you don't have to pay for your checking account. You can get low cost fees on almost anything you do, but this is actually not free. Using data from the OECD, the global financial system generated profits equal to roughly 6% of GDP, roughly $5 trillion last year. Okay, so that's $4 trillion roughly of cost to the global economy to operate the financial system. Now, what does that mean? Well, that means that the average person in the world that is using traditional fiat money spends about 3.5 weeks per year to pay for the right to use fiat money. So just think about that. We might think the financial system is free for us, but it actually costs us roughly 3.5 weeks of pay. Now, banks, they don't really do much to earn your trust and make you happy, but on average, they generate about $860 a year in profit per person that actually uses their system. That's almost 1,000 times what Facebook earns. Now, Facebook is the most powerful company in the world, yet they don't even make as much money off their customers as a bank does. Okay. Now, this is a chart just to illustrate how much the banking system doesn't even rely on the interest rate market to make money. The left chart shows you interest rates since 1970, and you can see interest rates have generally been falling. The chart on the right shows you the banking industry's financial capture. As you can see, the industry has earned a rising share of GDP despite lower interest rates. So again, the cost of trust in the financial system is actually growing over time. And you can see some stats. 5 of the US banks control half of all assets. Outside the US, it's even more concentrated. Typically, the top 3 banks of any country control 75% of assets. Okay. Now, let me just jump to demographics. Again, I just want to just make sure I'm not... Yeah, I'm going to just try to wrap this up quickly, talk about demographics, because I think this is really a critical section. What most people don't appreciate is demographics explain markets in ways that you can see from miles away. For instance, if you just use demographics alone, we could have predicted the stock market peak, every stock market peak since 1870, with a 40-year lead time. Now, how would we do that? Well, these are the 6 generations in the US. There's the greatest generation, they're the oldest. The silent generation, they were born during the Great Depression. Boomers, Gen X, Millennials, and Gen Z, roughly spaced 20 years apart. But because of birth rates and immigration and different mortality, the generations peak at different times. That's the column on the right. If I just took the peak of every generation against the stock market, you could see that the peak of every generation has marked a major market equity top every time. And in 2018, Generation X peaked. What happened? Global markets had a big drawdown. So one, demographics really explain markets and I think opportunities in ways that people really don't appreciate fully. And so let's think about how that affected investment decisions. Well, in the 1980s, consumer spending was set to really grow because the boomers were much larger than their parents, okay, so you had a much bigger generation, but their parents, because they were born during the Great Depression, were big savers, whereas the boomers were born in prosperity. So consumer spending tripled in that 20-year period, okay, that's what this chart shows. And it turns out if you just bought consumer stocks, the top 7 consumer stocks in that 1980 period went from $1,000 in value to $1.2 million. Okay, so you had over 100,000% return in consumer stocks. And what it means is if you bought a basket of 100 consumer stocks in 1980 and 93% went to zero, you still had a 12 times return on your investment. Okay, that's venture capital returns in owning public stocks. Well, of course, we know Gen X, which is the following generation, the same thing happened with the internet trade, right? Over that 20-year period, if you bought 100 internet stocks and 96% went to zero, you still had a 16 times return on your investment. And of course, because the top performing internet stocks had a 156,000% return. The point is, if you get the generational vector right, what will a generation do, you're going to have good realized returns. And I think in the current generation, millennials, we know they've spoken very clearly. Millennials don't trust banks. 92% of millennials don't trust banks. That's a Facebook survey. This is data from First Data. 71% of millennials would rather go to a dentist than visit a bank. And millennials are set to inherit a lot of money. Over the next 10 years, they're going to inherit close to $7 trillion. And you can see this millennial generation is already very much a digital generation. So what does this mean? So we think the cryptocurrency market, the only thing you really have to think about is wallet growth. There's roughly 50 million cryptocurrency wallets today that are active. That's probably a little high. But there's 2.5 billion millennials. So if 20% of millennials end up with a cryptocurrency wallet, that's 500 million active wallets. That's a 10x increase. And that would result in somewhere between 100 to 1,000x increase in the size of the crypto market. So again, this generational trade is really critical. And that's why I think Bitcoin is on its way to becoming an asset class. I'm going to wrap it up with just a few final slides here. But first, we know endowments are beginning to increase their investment in crypto. And we think that, and some projects have already proved their usefulness. Bitcoin, I think, has really worked really well as sort of your base currency or your store of value. Ethereum's proving its usefulness. But there's a few that maybe aren't as well recognized. I think XRP is proving it to be fairly useful in cross-border settlements. Binance is really showing that exchange tokens can be quite useful. And believe it or not, even Dogecoin has seen adoption grow despite the fact that it actually doesn't do anything. And in fact, these charts highlight this. This is slide 46, that if you look at the performance of cryptocurrency projects, which is the y-axis, and the x-axis is the change in active users, the best performing projects are those that actually have adoption. So again, usefulness is really determining which projects do well. I've got a few slides here. I think the slide's going to be available, so I'll just breeze through this. But one thing to keep in mind is that if you believe that the network value is driving cryptocurrencies, you can get an idea of what it implies for fair value. And again, I don't think you want to be judging the return of the crypto market on short periods like 12 months because it's a generational trade. But if you used a regression on network value, it implies that Bitcoin today, is worth roughly 14,000. And using a mining model, it implies, roughly 13,500. So in some ways, we can see that the cryptocurrency market is undervalued. Again, 2018 turned people bearish, but that bearishness of 2018, you shouldn't assume that that's what 2019 will look like.